Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking this time at the single best-selling tracker fund on the AJ Bell Youinvest platform at the moment, namely iShares UK Dividend ETF. This tracker product is an ETF or exchange-traded fund. It's designed to track, mirror the performance of the underlying assets and deliver that performance minus any running costs. Here, the tracker's following the 50 highest yielding stocks in the FTSE 350 index, excluding investment trusts. They're picked and weighted according to 1 year forecast dividend yield, so I guess the theory is they're the best of British when it comes to income. Now, iShares UK Dividend uses physical or direct replication to generate performance, so it owns the underlying securities. In this case, the 5 biggest holdings are Shell, Aberdeen Asset Management, BP, HSBC and TalkTalk. The chart here shows the tracker's weightings by sector. Note that financials dominate, with utilities, industrials and oils also prominent. The tracker comes with an ongoing charge figure of just 0.4% and it's got about 800 million quid under management. Dividends are paid quarterly and this particular instrument comes with income units, so any investor buying this will receive dividends as cash and not see them reinvested. As a final technical point, iShares UK Dividend is one of the 16 members of the top tracker list used by our investment guidance service, although it doesn't actually feature in any of the 3 model portfolios. So they're the mechanics. The question is, why would perhaps investors be buying now? And I think there are 2 possible reasons. The first is the tracker offers a 12-month dividend yield of 5.6%. Now that compares to cash in the bank at 0.5% on the base rate and a 10-year government gilt yield of 1.4%. It also beats the official inflation number of 0.5%, so it may well catch the eye of some income hunters. Second, the tracker's done badly of late, hampered by fears of the safety of UK dividends and maybe some contrarian buyers are sniffing about. No fewer than 13 members of the FTSE 100 elite have cut their dividends in the past year or so, and that's hurt this income tracker and income seekers. Perhaps therefore investors have decided the bad news is out, the dividend reset's over and it's time to step in. Let's see what happens. What I would say is that investors tempted by that 5.6% yield need to be aware that the potential return is high because there are clear risks, as those 13 divvy cuts of the past year suggests. Note that for the FTSE 100, not the 350 that's followed by this tracker, dividend covers got down to 1.4 times in 2015, when 2 or more is ideal. Earnings are forecast to grow faster than distributions in 2016 and 2017, rebuilding cover, at least according to aggregate forecasts, but even at 1.7 times for 2017, skinnier than ideal. Just looking at those bold numbers, more dividend cuts could be a danger, especially if the global economy slows down and earnings estimates disappoint. I'm not saying don't buy an income tracker, and this one goes beyond the FTSE 100 anyway, but I am saying make sure you check the potential pitfalls as well as the potential rewards to ensure this instrument, or any other security you buy, fits with your overall strategy, time horizon, target return and appetite for risk, to ensure it fits your personal needs and circumstances, because that's only something you can know. So thank you for watching, and I look forward to seeing you next time.